Assalamu alaikum wa rahmatullahi wa barakatuh. This is an introduction to the fundamentals of accounting. Accounting is an interesting topic because many people don't really understand it. They ask the question, why do we need accounts? Why do we need to do accounting? Well, fundamentally, accounting, the term accounting, is actually a language of business. It is a means by which the business keeps score. If you have a business, you need to know the financial health of that business. And accounting is the mechanism by which you understand the financial health. So, when you understand the financial health, you will understand whether the business is successful, whether the business has potential, and whether the business has sustainability to be able to carry forward the objectives of the business for the foreseeable future. And why do you need to have accounting? Well, accounting basically gives you an understanding of the wealth of your company or your business. It tells you whether your business is performing well, if it's making profits, or if it's making losses. It also tells you whether the business is a going concern. And what do I mean by going concern? Whether this business has a future, or is it a business that has some kind of sustainability to carry on in the future. It also helps you to understand the types of cash flows that come into the business and out of the business. Because most people think that when you have cash flows, it may necessarily be something, related to income and expenditure. No, cash flows could be other than income and expenditure. And of course, in a tax regulatory environment, you will need to know how much profit or loss you are making so that you can report that to the taxation authorities. Stop. So we need to understand how the business is performing, what is its success levels. And to do that, we need to know, or we need to compose certain statements, traditionally that have been provided by the accounting world to gauge or to understand or to have people understand how the financial health and how the financial performance of the company is being carried out. So what do? We need to measure the wealth of the company. And what is the wealth of the company? The wealth of the company is basically, in very simple terms, what you have and what you owe. You have something, say $100, and you owe somebody $50. Your net wealth becomes 100 minus 50. So your net wealth is $50. That is how you understand the wealth of the company. And this is displayed, or this is depicted in what is called the balance sheet. So in the balance sheet, you have two sides. You have a side that measures what you have, and it's called assets. As well as you have a side which measures what you owe, and it's called liabilities. And between the liabilities, there are two components. Or traditionally two components, there are many other components, but traditionally two components which basically indicate or identify how much you owe and to whom. You have one component which is called equity, and the other component which is called creditors. And the composition of equity and creditors will equal your total assets. So for example, if you have $100 in your bank account, it could comprise of $50 belonging to equity and $50 belonging to creditors. Equity being the amount of money that the shareholders of the company have contributed to the business, and creditors being the amount of money that, for example, a bank may have loaned the company. Stop. The other statement that needs to be looked at when we are measuring the health of the company is what is called the income and expenditure statement. And as the name suggests, it's very simply what the business is generating in terms of income. Revenue is another term, sales, etc. And it's measured against what the company spends to sustain the business as well as to generate the income. So, for example, in a trading company, the company may sell some type of goods or services, goods particularly, and they will have expenses which need to be, incurred, which is a direct or indirect incurrence against the revenue that they have generated from the sales of that particular product. And the profit is very simply the total income less your total expenditure. This is a very fundamental and very basic analysis of a income and expenditure statement. And it is combined, or the net result of the income and expenditure, whether it is a profit or loss, is basically combined with the balance sheet to identify and measure the complete health and wealth of a particular company. So, for example, in a very basic and fundamental setup, if, as we saw yesterday, the company has $100 to start off in the bank, and this $100, let's make it easy, is fully contributed by the shareholders. So you have two sides. You have $100 as an asset and $100 as a liability. And if that business was to generate a profit of, say, $50, and that profit of $50 that profit of $50 was generated by selling $100 of goods after incurring $50 of expenses, so you have a profit of $50. Assuming that profit is all cash, then what you will see is a growth of your balance in a bank by $50 and a growth of your equity by $50. As we said in the earlier example, the balance sheet must balance, so the total of liabilities must equal the total assets. This is basic, and this is very fundamental in terms of a very rudimentary understanding of accounts. And inshallah, perhaps in future lectures we can go into more details and understand the detailed mechanism of accounting. Thank you very much, and I hope these videos will have sufficed for you, and we look forward to hearing from you soon. Assalamu alaikum wa rahmatullahi wa barakatuh. Assalamu alaikum wa rahmatullahi